get educated. If you're feeling that you're on the fence and you want to get into multifamily, make sure that you get educated and you position yourself for your success, because you can actually leverage others people experience to shorten your timeline to success by learning from their mistakes.
Welcome to the Bulletproof Cash Flow Podcast. Let's get into the show.
Hey everyone, this is Agostino. Specializing in long distance or out-of-state investing is very, very different compared to what most people do. Well, today's guest understands how to execute the strategy of out-of-state investing. His real estate background started helping his father's rental businesses in Israel, but over the years, he implemented very different strategies, including wholesaling, house flipping, development, and multifamily investing. Once he learned the ropes, he was able to build his business to what he has today. His portfolio includes multifamily apartments and commercial with triple net leases throughout the United States and New Zealand, where he currently resides. Today, as a principal of MFI Holdings, he and his team help investors from all over the globe invest in deals here in the U.S. Now, with all that, I'd like to welcome Hadar Orkibi to the show. Hey, Hadar, thanks for coming on, man. Appreciate it.
Thank you, Agostino. Thank you for having me. It's a pleasure.
Yeah, excellent, excellent. Now, if you like what Hadar has to say, you can reach him via his contact page at mfiholdings.com. And if you like our content, please don't forget to leave a comment and rate the show. It helps us out tremendously when you do. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Hadar, go ahead and tell listeners about how you got your start.
Great. So briefly, you touched on the principle. But back in the day when I immigrated from Israel, I was born and raised in Israel, and I immigrated to New Zealand with my now wife, but back then girlfriend. And I started getting interested in real estate in the early 2000s, really when things started to pick up. We entered the last cycle, the last boom, if you like, that lasted until 2007, 2008. And I was working in the vineyard and orchards of Central Otago, manual labor, just fresh into the country, trying to find something to do in terms of making some good money to start a new young family. And I really started educating myself, listening to a lot of back then CDs, if you like, while working. You're doing a lot of manual labor, but really doing educating myself at the same time, and reading a lot of information online on real estate forums and alike. Slowly but surely, I started wholesaling properties from a signing contract to then gradually closing on deals, renovating them and selling them, and started building my buy and hold portfolio in New Zealand. Over the years, the portfolio grew, and we basically got to the point when the New Zealand property market has appreciated so much and matured, if you like, that the cap rates compressed significantly. So it really became more like a market like San Francisco, New York, if you like, Boston, where it doesn't make any more sense to go and buy an existing stock to get a good cash flow. So whatever I bought over the years, in the last 15 years, it has a lot of equity in it, and it's cash flowing now because a lot of time's gone by. But now I realized about 4 years ago that if I really want to grow my cash flow, if you like, my cash flow business, I need to look further afield, need to look into the US. Because I'm an American citizen, I'm able to borrow money in the US, do business in the US, and of course travel regularly. So that's when, Agostino, I decided that I need to educate myself, choose a market, and pull the plunge and go all in and make it happen.
Excellent. Excellent. So now, how do you select your markets these days? Like, how do you know where the best place is to invest, considering where you're living right now? Because obviously you're not local, right? And picking where you're going to invest is obviously a huge, huge part of building success in this business, right?
Yes, absolutely. So we really want to have, there's quite a few metrics, if you like, and fundamentals that we like to see in a market. But one of the most important things that we want to see is when we're researching a market is job growth and population growth. We want to see a steady economy with a good price to rent ratio. If I want to go and buy properties which are not cash flowing properties, I didn't have to come to the US. If I want to invest in a market that it's mature, that you get 5 or 4 or even anything up to even a 6 cap, I don't have to go all the way to the United States to do it. For me, my strategy is to find a steady market that I can still get good cash flow. So the price to rent ratio needs to be reasonable. So again, job growth, population growth, steady economy, and a good price to rate ratio. When we're talking about job growth, I would like to see minimum of 2% over the last 2 years. So we want to see a trend that it's moving. We want to see that there are businesses that are moving into town, there are expansions, and there are opportunities for employment. We'd like to see, up to before COVID, we'd like to see an unemployment of below 5%. Below COVID, the US unemployment rate was 3.6%, roughly around the general in the good metro areas. Back in 2010, though, the average unemployment rate was about 9%. So, you really need to consider that and take that in mind. Now with COVID, it's a whole different story. But those economies and those cities which has good employment, have a good diversity of employment opportunities, are providing obviously stronger tenant base that are able to weather the storm.
Right. So now, when you're looking at these markets, I'm assuming you're still looking at them today. Are you considering pre-COVID versus post-COVID? Like, how did it perform before, and to see if you're try to find some deals, that kind of thing? Are you doing that?
I'm focused, and that's something that we teach as well in the MIH Mastermind. We know when you're going, and especially if you're new and you want to get into the market, we suggest that you choose one market and you get to know that market intimately, form the relationship, form your teams, and really drive for dollar. Get to the point when you really know the market well, and execute and work hard in that market. If I actually tried earlier on to branch into other markets while I'm working hard in my core market, which is Arkansas, I went to work in KC. So I was building relationships over there, got to know the market, the location, the zip code. But I found out that it was really challenging to, if you like, to work the market, work a relationship, underwrite the deal, get to know it really good as a one-man band. So what we do now, and what we have done, is we built. I joined up with the group with another 3 or 4 investors, and we split the roles, and we walk the other market, like the secondary market, if you like. I do that with the group, with the team, which through the MIH Mastermind allowed me to actually do that. It's just a no-brainer. You can't spread yourself too thin.
Oh yeah. Well, that's the thing, though, right? It's like, I'm a big proponent of buying your local area, buying your own backyard, and if your backyard is not so good, go to a different backyard. That's move. That's what I did anyway. But
Absolutely,
yeah,
absolutely.
but in your case, with your core market, then you're looking at Kansas City. It's also far enough away that's, it's a little ways away, but then trying to duplicate everything all over again, all your processes is easy. But when it comes to the people, your property management group, your contractors, your brokers, those are the key people that you need to have on your team. And to try to do that right from scratch, for some people, it takes a while to build all that out, especially if they don't know you, right?
Exactly, because it's cultivating those relationships. It's following up with the broker regularly, following up with even with the owner. Because in my market, I got to know a lot of the private investors in the company and the owners who own some portfolios in my market, and I want to cultivate those relationships. I want to build those relationships. So if ever they want to sell, or if ever we want to have a discussion about maybe doing something together, there is a relationship in place. And it requires a lot of focus and a lot of work. And if you're trying to do the same in a different market on your own, it's just, I find it to be it's exhausting, and it's just too much. So that's why I decided to split that work with some other team members. But one thing to mention, Agustino, is that when you go into a new market, your key element for success is building enough, the good team on the ground. You want to have the number one. If you are out of state, you want to have a good, reliable third-party property managers. You want to be able to leverage their expertise and local knowledge, if you like, about the market. So first, you need to learn about the zip codes, about the areas, which if you like, roads. Once you pass this line or that block, it turns into being a war zone, or above the railway track, if you like, it's a good area, or below, it's a bad area. You really need to know the demographic of the market intimately if you want to be successful. So a property manager is great. They're also great for referrals, to start building your subcontractors. See, when we have a project, when we need to renovate an apartment building or anything like that, some of the work that we're doing, we are channeling through the third party property manager. But nowadays, some of the work we actually I manage the subcontract the contractors myself as an asset manager, because I built my own team. So I have a maintenance guy. You're really important to have boots on the ground. And of course, another very important team member is to start establishing those relationship with local lenders earlier. Because if you find a good deal which has a lot of meat on the bone, perhaps it's 20% vacant, perhaps there are some issues with the properties, if you like, a lot of economic vacancy, meaning that there are tenants there but they're not paying rent, heavy lifting. You really want to have a local bank that is confident, that knows the areas, that have confidence in the location, to give you at least a bridge loan until you can refinance to a better debt temporarily. We see that sometimes we take a community bank, if you like, for a period of 1 or 2 or 3 years, and then we refinance into an agency debt, which is a long-term Freddie or Fannie financing. So in that way, those relationships can really save your bacon, if you like, at the time when you need to get a loan for a property which is it's difficult to finance through an agency debt because of those reasons.
So it sounds like then you're using like local community banks. You're not going through a broker. Then you're trying to hit up those individual lenders.
Yes. So one of the first thing I did once I chose my market, I built my team. I got a property manager. I network with local investors. Very important. Jump on Bigger Pockets. Find out who are the investors over there. Attend meetup, and you need to be committed to visit your market, whether you are in New Zealand, in Australia, or whether you are in America, in a different part of the states. People are complaining about flying from, for example, 6 hours or 5 hours or 3 hours to a different market. Guys, remember, I'm flying more than 15 hours to get to my market. So if I can make it, you can make it as well. It's very, very important. It's all about mindset. So to answer your question, to Agustino, yes, having a stabilizing relationship earlier with community bank in your market is very, very important. I at least, have relationship with at least 3 or 4 banks. I opened accounts with 2 of them at the moment. I'm banking with 2 of them early on. When you decide on the market, go and open an account, put $1,000 into a saving account, get a secure credit card on $500, which is against half of that 1,000 that you had, and put a small payment on that credit card, like a subscription to a magazine or whatever, just to start building credit record with that bank. Once you're a client, once you're a customer, and you talk to them and you follow up. We follow up with our lenders as frequent as we do with our brokers, just to touch base, just to give them feedback about the project, but just to see what's their appetite, if their appetite changed. For example, to finance some other multifamily opportunities. Do they see any other owners that have difficulties, and they're discussing with them on some, if you like, better their terms, for forbearance and stuff like that. It's very, very strong word we've seen in the last few months. So very, very important, because those relationship is the relationship that will come and help you when you need to take a deal which is a value add deal. Absolutely.
Yeah. Now, do you ever use any type of brokers, any type of those lending relationships, so you're not totally dependent on the local lenders? You ever do that?
At this point, I didn't need to. I am going to use a broker, obviously, when I'm going to refi one of my properties. I'm going to go to agency, so I'm going to go through a broker. I do have a broker which I establish relationship in my market, and that's for the purpose if I need to, obviously, to get financing that I can't get through my relationship. And I really recommend people using brokers if they need to. If you get stuck and you're not happy with what you get, I think brokers worth the weight in gold. Typically, you're going to pay anything from 1%, sometimes 0.5%, depending on the size of the deal, or even 1.5% origination fee for the broker. And brokers know which lenders have a specific appetite for a specific deal. So I really recommend people to have a discussion with local brokers. One tip I would like to mention, Agustino, I'm wanting to make sure that I bring across everything that I can at the moment with giving value to your listeners, is that when you're going into a market, you want to start a discussion with your local lender, with your property manager, and with brokers not just mortgage brokers, but also brokers who are selling, real estate. You want to ask them, what is the typically expense per unit that they see per apartment per year in that marketplace? Because when you go and you're new in the market, you want to know that you're underwriting, that you're analyzing the deal correctly. And not just for the purpose of you not doing a mistake and maybe, if you like, underestimating expenses in that market. You want to make sure that when you analyze the deal and you're going to apply for financing, you're actually presenting your lenders with the correct assumptions. Because if you go in and you give them your underwriting, your pro forma, if you like, and you allowed for example, much lower expensive per door than what they underwrite or what they know that the market is actually operating in, then you're going to lose your credibility with them, and they will look you as a higher risk because you're being over optimistic about how you can operate the deal. So it's very, very important to, when you go into the market, to ask lenders, even mortgage brokers, and property managers, what they see as an average operating expenses per unit per year in that market, in that particular, if you like, sub market or area within your market.
Yeah. Well, I mean, and that part's huge right there too, right? I mean, you really need to know what you're dealing with in a given market, what the expense ratios look like, maybe depending on the asset class, right? But the typically, you might be looking at, say, 100 deals a week or something. If you're really, really aggressive, right? That's a lot of deals to be looking at. But banks, lenders, they're looking at thousands of deals all the time, and some of them they pass on, some of them they don't. So you're absolutely right. I mean, trying to figure out what they have an appetite for, what sort of assets do they like, is huge. I mean, we're dealing with a lender out of New York City, and or rather a broker, and their lender, the one we do a lot of business with, they love Ohio. They just love Ohio, so we do all of our business there. But we're also doing triple net with the same broker, but they have different lenders for that, right? So why? Well, because different lenders have different appetites for different asset classes, and that part is huge. But I totally agree with you. Getting a broker that you can really know and trust on board can really help you in case, like, say, for instance, you get a deal under contract, it goes 30 days, you're past due diligence now, and for whatever reason, that lender goes sideways, they go dark, whatever happens, that broker can now find a replacement for that lender, right? It's their job to find another solution for you, right? So as opposed to going to a local lender, having to do all the legwork, and then it goes sideways. Now what do you have to do? You have to stop what you're doing to try to find this another lender, which can be very, very aggravating. Just to save 1%, it's totally not worth it, right?
Absolutely, it's the cost of doing business. And one more thing to mention about that is that it happened to me. I got this really good deal that I was working on for 18 months. I got it off market. We're not going to get into the whole story of right now, but generally speaking, it had loss to lease, which is below market rents of close to 30%, and it had another 28% of vacancy, economic vacancy including. So. And I had 3 community banks told me that they will be happy to fund it. But when they went to committee to approve the final loan, of course, some of them have a committee, if you like, which is a group of people that meet up to discuss your loan application and get it approved. So some of them have 15 people of the committee. Some of them could have 5 people. Some of them could have maybe only 2 people within the branch making decision. Like it happens in, I saw it happening in credit unions. They're regulated a little bit different as banks. They can give you longer amortization, and they can give you better terms on refi and stuff like that. So just for the listener, keep in mind, always check with credit unions. They are good to work with. So those 2 of the lenders that took me for lunch, they paid for lunch, took me for lunch. They brought another team members, and they say how much they want to see me, helping me with the deal and getting in and funding the deal. In the end, they went to committee, and the 15 people couldn't make their mind of. Because there's so many people on the committee. It's enough that 2 or 3 say, "Hey, Hadar Orkibi from New Zealand, although American citizen, has experience, has been in real estate for nearly 20 years, but still he's in New Zealand. Too risky for us. Thank you very much. Not interested." So at the end, it happened to me with 2 banks. At the end, the one that came to the table and funded the deal was the lender that I had cultivated a relationship with for many years. I opened the bank account, I put a little bit of money in, I had the credit card going, and they gave me the funding. So they gave me the funding, they gave me construction loan to cost. And at the end of the day, we bought the property, and then they lend us the money to the rehab, which was about 360,000. So the terms wasn't ideal. I didn't get the best interest rate. I didn't get the longest amortization. But now we are already, I think I'm about 9 months, 8 months in, and now I'm ready to refi because the asset is stabilized. We more than doubled the income. So I went back to this bank and I said, "Hey, are you able to? You want to adjust your terms and maybe we can restructure the loan because now the asset is stabilized?" And they said, "Listen, because we originated the loan less than a year ago, we can't really do it. We can probably give you a discounted interest rate, but we can't refi you now to the after repair value of the property, which is we took it up from 1.4 all in with the rehab. Now it's about 2.1. So I want to go and get all my money out, refi and roll the money into the next deal. So that can't do it. I can't go to agency either because I didn't own it for more than 1 year. They want to see to get maximum leverage, you need to own the property for 2 years. So
Right.
if I'll go after 12 months, I might get 70%. Or even maybe 75%. No, probably 65 to 70% nowadays. So if I want to go and get 70% or 75%, meaning that I have 25% equity left in the deal and pull all my money out, maybe even a bit more, I need to go to a third bank, another bank. So I'm now shopping with a credit union that already showed indication that they will potentially lend the money and keen to do business. And if I'm not going to get good terms from them, I'm going straight to the broker, and I'm going to get the broker. That's what I want. Find me who is going to be the lender. And like you're saying, 1% to get all your money back in less than a year, it's a no-brainer.
Right. Right. And that's very sound strategies. I mean, very sound strategies there. It's just like you said, though, when you're in a pinch and you got to get the deal closed, it may not be the best terms, it may not be the best amortization, but you got it done. Right. And that's way better than losing a deal altogether. You never want to lose a deal after you commit to doing it. Right. That makes you look really, really bad. Really
Yeah,
bad.
absolutely. And when you do the deal analyzing, you need to allow for the first, 18 months or if you like 2 years even with that particular debt. So,
Yeah.
I always say it doesn't matter as much what cap rate you buy the property at or what is he doing in the first year. Because if it's a good value add deal with a lot of meat on the bone, of course it's going to have a lower NOI, net operating income. Of course it's going to have lower. That's what you want. The most important thing is where you can take the property to, because once you stabilize the asset and after 18 months or 2 years you really increase the net operating income, you not only increase the income, you also increase the value, and that's where you're going to reap your rewards.
Yeah. Yeah. Now let's talk about property management. And finding good property managers is always tough. It's probably one of the biggest the biggest hangups for many people, especially new people getting into the business too, right? Especially for those guys. How would you recommend someone find a property manager for a market that may not be familiar with?
The number one advice that I can give people to find a property manager, an attorney, title company, and even a local lender is referrals. You want to get referrals. Referrals, it's a proven, if you like, more proven than just cold approaching somebody. So you want to ask your fellow investors that you networked with on Bigger Pockets or network with in another meetups in your local area. You want to get that. You want to get referrals. And then you need to, of course, meet with the property manager. I recommend you talk to at least three, and ask them the question. Ask them specific question that you need to ask to vet them. If anybody wants, I have a list of questions that I ask property manager. They can contact me through MIHmastermind.com / it's a contact us page. You can see it there, MIHmastermind.com. On the contact us page, ask for the question to ask a property manager, and I'll give it to you. Because you want to make sure that their operation, the way they operate, is aligned with your strategy, with your vision, and your goal. You really need to make sure that they are going to be a good fit for you. So it's very, very important. I think that one of the important thing is also to see if you're out of states, if you are comfortable with the way they generate their monthly reports. Some of them will have an online access when you can log in and you can see the transactions on live basis on the cloud, if you like. Some of them won't. So you need to make sure that you are comfortable with that. In my case, I actually have a property manager that I'm very pleased with, and but they don't have this option, which in time it's kind of I wish they had, but I found a way around it. As you know, Agustino, we when we're growing a business, it's all about creating systems and processes. So I created a system with my assistant that she is now going over the statements on a monthly basis, reconciliated with the invoice that they paid, breaking it into different categories of the expenses, if you like, that they paid for, and we check it out with what we know in the rent roll, and really monitor those occupancies, if there are any delinquencies, and any tenants, if there are any due for rent renewals. So we're really doing the asset manager in the back end with assistant. Very, very important.
Yeah, yeah, absolutely. I mean, I personally, I will only deal with a property manager that actually has the software. They made the investment in their business to have software. I mean, I only have one property manager that handles everything. So we use third-party management at this point, but it's one of those things that as an owner, as you continue scaling your business, you really got to have that. You got to have that insight. You got to see what's going on inside those properties, and if you can't see it, you better have a lot of trust in that property manager that everything's going the way it's supposed to go. Right? That's the thing. I mean, it's very tough to do. Now, are you doing like weekly meetings? What sort of touch bases are you doing with your management team to make sure they're doing what they're supposed to be doing? And how often do you do that?
Yes, so I totally agree with you. So transparency is very important for me as well, and that's why I'm onto them. You know, I'm considering myself as an asset manager. I'm a very organized person, and I put the systems in place to monitor them, keep them accountable and on track. Whether we have a rehab budget, whether there are a specific threshold of work that they're allowed to do and spend on without telling me. When we have a project that is ongoing, I will be on them. I'm always on them, at least on the call of my property manager once a week. But if there is an ongoing project, I know that there's ongoing milestone that needs to be taken on a specific project, even if it's within a week, I will be ringing them whenever necessary. So I'm typically using text or email or calls. I always jump on a call when I want to get a good update, and they have the hierarchy, if you like, within their company, that there is the property manager. Underneath, there is the assistant property manager who I communicate, or my assistant communicate with when we need to get leases update. So I know, hey, this lease expired or about to expire in 30 days. Are you going to approach her to make sure that she's renewing? Or if they did, please send us the list so we can record it. So one of the things we do is, of course, I said, touching base with them on a weekly basis. Every month that we get the statement, we monitor it. We check the expenses, that there was no double charges. Sometimes there's mistakes, and we found some mistakes, and we approach them. Hey, why is it being charged twice? Or what's going on? We make sure that we keep them accountable for that. One of the things that we do, we use a system. It's an add-on. It's called the Add Reminders. It's basically a sheet add-on, Google Sheet add-on, that we could set up to get notification 30 to 90 or 60 days before, if you like, when the tenancy is expiring. Before it's expiring, I'm getting an email, my property manager getting an email, the property manager assistant getting an email, and my assistant getting an email. Hey, the resident in apartment 104 is expiring in 30 or 60 days. Whatever we set it up for. Please check if they want to renew, or do we need to start advertising the property. So because tenant retention is key, you see, and that's something that a lot of property manager, a third party, they're not going to be onto it as much as you would as an asset manager, if you like. If you're able to roll them into a new tenancy smoothly, not only you save yourself the time to go and look for another potential replacement, but you saved your money about unit turns and vacancies, and the time it takes and the money it takes to replace a tenant. So it's very, very important to be organized with that. Another thing that we do is we manage the marketing side on Facebook Marketplace, because the Facebook Marketplace, it's kind of like the shotgun approach. You put them out there and you get so many inquiries that I know that my property manager will not deal with them as fast as we like to respond to people who inquire. You see, that's a whole different conversation. But what we do is that we set it up on a Facebook page for the community, and we advertise the apartment over there for sale. And when somebody is inquiring, is generating an automatic response to them with their first name and with a link to the 3D walkthrough for the property, and the property manager direct phone numbers, the mobile and the office number. And that allows them to basically get all the questions that they may have, including seeing the property. And it says, if you like to schedule a physical viewing, call the office. So in that way, though, sometimes they have other questions. So that's where I'm jumping in, or my assistant jumping in, just to answer. Some of them said, hey, I like it, I'd like to apply online. So we just send them the link. But when you get 20 or 15 of those, a day, you can't expect your third-party property manager to show a great customer service and have a dedicated person there responding all the time. But we like to make sure we give the customers, if you like, a resident, the best service we can, and just show that we responsive. Because if you're responsive on the advertising, they'll know that you'll be responsive with their maintenance request and all along the relationship of having them as a resident in your community.
Right, because that part's huge right there, right? You want to try to reduce those turns, right? But that's exactly it. Something you reminded me of too, something that many people don't do, is if you use that spreadsheet add-on for Google Sheets, you can, as you get new tenants coming in, and maybe they don't rent from you, but you have their email address, right? Because maybe you communicate with them by email. Maybe it's like 30 or 60 days prior to them from the last time, the same time last year that they might have come to see the property. They go visit somewhere else, but you can use that reminder to reach out to them and say, hey, listen, I know you went somewhere else. If you want to reconsider coming out here, we'll give you a free microwave. We'll give you something, a free fan or something, just to get, if they lease from you or something. But basically being smart around reaching out to those leads afterwards to possibly get them in the door again, a second time around, right? But there's so many different things like that really aren't done. And I find that those types of scenarios really happen when you own the property management company. So not always a capability thing for people starting out, but I guess keep it in the back of your mind out there, guys, as you're growing your business. Maybe they'll do that for you, right? Who knows? I guess, it could be a very powerful tool. It could be a very powerful tool. So, you know what, Hadar, let me ask you one last thing here. Someone's listening to this right now, and maybe they're on the fence about doing real estate. Maybe they heard a lot of great information here, but what is that one piece of bulletproof advice that you would give them?
It really depends on the stage that the person is in. If you already started and you've done your homework, you choose a market, and you're trying to pick up traction, I suggest keep networking and try and avoid the shiny object syndrome. Stay focused, stay persistent. This is a long term. It's a marathon. It's not a sprint. You're not going to achieve your goal. It took me 18 months to find this home run deal that I'm going to refi, roll all my money out, and still, after no money down in the deal, generate $70,000 a year. That takes a lot of hard work and time. So keep that in mind. That's number one. Just keep pushing. This is I know it's frustrating. I know it's hard, but that's why you need to also to surround yourself with like-minded people. Whether you surround yourself with the mastermind, or whether you keep listening to this great podcast and getting yourself educated and getting all the energy level up, so you can stay in the game. And the other thing is really get educated. If you're feeling that you're on the fence and you want to get into multifamily, make sure that you get educated and you position yourself for your success, because you can actually leverage others people experience to shorten your timeline to success by learning from their mistakes. That's crucial. It's crucial.
Yeah, 100%, 100%. You don't have to make the mistakes from you don't have to learn. You can learn from other people's mistakes, basically. You don't have to make them. Right.
Yes,
So,
and a lot of things out there now, Agustino. When we started, as there wasn't a lot of online content. There was no
yeah,
podcast. There was no YouTube. We bootstrapped. So now there's so much out there. You just need to choose good one horse and just go for it, and make sure that you're in an environment that it's supportive. Because this is a marathon. It's not a sprint. It's not an overnight success. It's not get rich quick scheme. This one.
right. It's not get rich quick. It's get rich for sure. That's what we got.
That's right. That's right. Absolutely.
Yeah. All right, guys. Well, if you want to reach out to Hadar, you can reach him through his website at mfiholding.com. I hope you got some insight on how to build financial freedom from just about anywhere on the globe. Thanks for tuning in, guys, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cash Flow podcast.